Hi guys, a very good evening. Guys, can you hear me? Can you see me? You okay? You okay, everyone?
Yes, sir.
Okay, give me a moment. I'm just trying to get my questions sorted on screen. Give me a second, guys. Just trying to. Just sharing a tube, but it doesn't get sense. I'm just sorry. Says done. Let's say. All right. Good evening. Good evening, everyone. And first and foremost, thank you for joining in here. And we are officially looking at starting our marathon session from today onwards. Okay, brilliant. Well, I'm just trying to take the. Okay, there you go. Okay, super. So, guys, this marathon is specially primarily targeting students sitting for December exams. And I'm sure all of you in here are students from the December exams, right? For the ones who know me, you really know me. But for the ones who do not know me, um, I am, oh, I am Ziyan. I've been tutoring for the ACCA subject ACCA over the last how many years? Over the last 10 years. I've been teaching across different countries, particularly students coming from India, Maldives, Vietnam, Colombo, Sri Lanka. And oh, why can't I update this? Is it okay? Is there any problem in here? Okay, let me move to trash. But I think this is not the updated version, is it? Can I do it at least now? Oh, no, 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 no. What's happening? We have anyway, I can upload it. Okay. At least let me take it on explain. Okay, there you go. I've been producing prize winners almost in every exam session. And last session, I had world number 2 for FR and world number 1 for audit and assurance. Okay, that's a little about me, but I'm not going to go too much into it. But today it's primarily about our December exams, right? Now, when you take the December exams, like you already know, we've got section A, we've got section A in our syllabus, we've got section B in our syllabus, and of course, we have section C, which is going to be 40 marks in the exam. Section A and B put together will be 60 marks, made up of MCQs, multiple response questions. We've got drag and drop options, number entry. So we've got different aspects in terms of section A and B. However, when it comes to section C, it is going to be 40 marks, but primarily, we see your examiner is testing these areas. What are your areas? Ratio analysis is one of your examiner's favorite areas, but students mess up there. Students mess up ratio analysis. Number 2, consolidation is one of your examiner's favorite areas, but to a major extent, students are getting it right. And of course, company accounts. Company accounts is income statement, balance sheet. Yeah, students are fine with that. But students, most of the time, they panic with ratio analysis. So my marathon session is primarily trying to touch these areas, right? These 3 areas. But when I'm touching these areas, by default, when you take company accounts, I will be touching section A and section B as well. So as much as possible, the objective of this marathon is obviously whatever you studied over the 80 hours period, 80 hours time frame, to simplify, to bring it within a week. So we've got about 15 days for the exams. Today is the 18th. So we've got about 15 days for the exams. I'm trying to shorten, squeeze things. So I'm going to be quick. I'm going to be fast. I'm going to be quick. I'm going to try to see maximum how we can utilize the time period. But before everything, everybody with me, do you understand? Are we ready for it? Yes or no? Are we ready for it? Yes or no? Everyone. You ready for it? Super. Uh, guys, guys, like I told you, one of the primary areas of today's session is going to be my ratio analysis, which is our primary area. I'm gonna take you through the theory, and I'm gonna try and do a question with you. Clear? Brilliant. Okay. You can of course take notes, no problem, and I will also try to share whatever I'm doing here to you so that you can also uh, use them. Brilliant. Guys, we're going to quickly look at interpretations. Interpretation, the term means you're trying to comment on what has happened in terms of the financial statements. Now when you take the financial statements, I'm talking about the income statement, I'm talking about the balance sheet, the statement of financial position of the company, cash flow statements of the company, statement of changes in equity. So you're going to take everything and you're going to interpret means comment. You're going to give comment. So don't worry about your language, don't worry about your English. Don't think, oh, I don't know if my language is correct. No. What matters to the examiner are your points. As long as you can give proper points in the exam, you should be fine. So basically what I'm going to do is I'm going to take you through some points in terms of interpretations so that crystal clear it goes into your head. Okay, these are the things that you need to keep in mind. So when you get in the exam, you can work around these areas. Brilliant. Now, under interpretations, one of the primary things that you probably be getting is interpretations, profitability of the company. Are the company profitable or not? Liquidity, what is the cash flow position of the company? And then we're talking about gearing, working capital gearing is what is the financial risk associated with the company. So first, I'm going to talk to you about profitability. So profitability. Profitability speaks about uh, what is company's profits, are the company's profit making, the company is not profit making, what has affected revenue, cost, where do we have to manage in terms of increasing the profitability, or in the past what has happened, the company has the profitability has come down, the company is making losses from profit to losses or losses to profits, the reasons. And a primary ratio that your examiner expects you to know is your GP margin. Your gross profit margin is your gross profits over revenue into 100. Guys, you need to memorize it. You need to know it in the exam. Sometimes your examiner gives it. Most of the time, no, you don't get it, but you need to know it. So your GP over your revenue into 100 is your ratio. Make sure you know it entirely. That is number one. Your GP margin, okay, I'll write it for you. Yeah. Your gross profit over your revenue into 100. That is the first ratio that you need to keep in mind. Why can there be a fluctuation? Why can there be a fluctuation in your GP margin? Why your GP margin can come down or why it can go up? It can be affected by few variables. One, first variable that you can keep in mind is your selling prices. Your selling prices obviously will have an effect in your GP margin. Why your selling prices is connected to revenue, so that can have an impact. So you have to keep that in mind. Number two, your sales mix can have an impact on your GP margin. Number three, your purchase cost can have an impact on your GP margin. Your purchase price can have an impact on your GP margin. Obviously, because when you take gross profit is after cost of sales. Cost of sales has this purchase cost in it. And of course, if you're producing, you have your production cost, which can have an impact. That's something that you need to keep in mind when it comes to your GP margin. Yeah, are we clear, everyone? Yes or no? Are we clear? All right. Now, the second thing that we probably will have to be talking about in the exam is going to be our operating profit margin. So operating profit margin is made up of profits from operations, operating profits over revenue into 100. So our operating profits over revenue into 100, that can have an impact on our operating profits margin. How can our operating profits margin be affected? Why can there be a fluctuation? Number one, because of our gross profit. Our gross profit can have an impact on our operating profit margin or our expenses. Number one, GP, gross profit. Or number two, our expenses. Our expenses means I'm primarily talking about, if it's operating profit, it's admin and distribution. Super. Number three, our third ratio that can be tested under our profitability is our asset turnover. Now, coming back, our asset turnover speaks about how much of revenue our assets are generating. We have got our revenue. So our revenue is generated to our assets. So how much is it generated? How do we calculate? It is calculated based on revenue over our capital employed. So when you're taking capital employed, you normally take your equity plus long-term liabilities, long-term funding. So that is our asset turnover. And why can our asset turnover have an impact? Why can it fluctuate? Our asset turnover can fluctuate because obviously, revenue increase or decrease can have an impact. So revenue goes up or comes down can have an impact. Number two, capital employed. Speaking about non-current assets increase or decrease can have an impact. And obviously, number three, our working capital. Our net assets, we're talking about net assets, capital employed. Yeah, capital employed. So basically, our working capital increase or decrease can have an impact. 1, 2, 3. And one of the other primary ratios that we have to be very careful in the exam is our ROCE. ROCE is one of the primary ratios for a shareholder. So as a shareholder, you're putting your money in. For the money, the capital employed, what is your return? So that is calculated as operating profits over capital employed as a percentage. Okay, now why, what is ROCE? For the money that we have invested, capital employed, the profit that we are generating. Where can we have an impact here? Our ROCE can be affected through our efficiency. How efficient are we in terms of generating profits? Number two, profitability, our movement in operating profit margin, our operating profits going up, coming down, or it can be combination of both. So our ROCE is affected by number one, efficiency. So movement in asset turnover. Asset turnover, this particular thing, asset turnover can have an impact on our ROCE, number one. Number two, movement in asset turnover. Number two, profitability. Profitability means in this case, I'm talking about operating profit margin, because here we are talking about operating profits. Movement in operating profits can also have an impact on our ROCE. So operating profits. Are we clear? Are we clear? So when we are talking about ROCE, ROCE is connected with your asset turnover. Your asset turnover, which is your revenue over capital employed, and your ROCE is connected. What is the connection? Your operating profit margin into your asset turnover gives you your ROCE. Your operating profit margin is your profitability. Now, when you're talking about ROCE, that is about profitability, and your asset turnover is your efficiency. So you both put together, you will still get your ROCE in the exam. Okay. Are we clear? Are we clear? Okay. This is the first part of our profitability ratios that you got to keep in mind. Relevant for your exams. Okay, brilliant. Understood. Okay. Now, if you can keep this in mind, the movements and how this is affected, that is one way you can work around in your exams. That is one way you can work in your exams. Okay, worst case, if you don't understand the logic, that's okay, memorize it and try to connect it in the exam. In the exam, connect it with the scenario. I will do it with a question so that you will understand it better. Okay. Now, that is our profitability ratios done, which is relevant for your exams. Number two, I'm trying to get into the liquidity ratios. So liquidity ratios. Okay. Now, when talking about liquidity ratio, one of the most important is your current assets over your current liabilities, your current ratio in the exam. I see this very often. So you need to know your current ratio. Your current ratio is your current assets over current liabilities. How much of your liabilities can be covered by your assets? Because at the end of the day, liabilities are payables within next 1 year. With our current assets, how uh, how can we cover it? How can we cover it? Okay, I've noted. I'm getting so many questions. I'm noting. But guys, you need to understand this is not a fully fledged class for me to sit and do all the questions that you give me. I'm so sorry, I won't be able to do that, but I will try to cover as much as possible for the exams. But if you want me to do it personally, then we can look at it personally. Here I have a time restriction. Okay. So current ratio is my current assets over current liabilities. That is one important ratio. How can your current ratio? Okay, current ratio can also be connected to our quick ratio. Our quick ratio is also very similar, but with one difference. You have to exclude inventory. So basically, when it comes to quick ratio, please take your current assets less inventory, exclude inventory over our current liabilities. Yeah. And then your changes in your current ratio or quick ratio can be due to few things. Number one, movements, ups and downs, movements in cash balance can have an impact. Obviously, current assets means inventory, receivables, and cash. So movements in cash balance, trade receivables, and inventory. That is not one factor. Second factor, movements in trade payables can have an impact. So what you have to do in the exam is individually go and check what has affected, what has made an impact, and you have to try to work around it. And next ratio that can come under liquidity probably is your inventory turnover. Your inventory turnover is your cost of sales over inventory, right? Inventory turnover is different to inventory holding period. Okay. Now, when it is inventory turnover, you're talking about number of times your inventory has mixed has been changed, has been turned over a period of time, right? So number three, your inventory turnover. How quickly are you using your inventory? How quickly are you selling your inventory, in other words? So your cost of sales over your inventory. So you're looking at the efficiency. How efficient are you in converting your inventory into cash? In other words, higher efficiency gives you higher turnover. There you go. Next point, your inventory holding period. So that is number, this is number 3. And number 4, inventory holding period. Very frequently tested. Very frequently tested. Obviously, you know, inventory over cost of sales into 365. This tells you on average how long are you holding on to inventory, right? How old are you? How many days are you holding on to inventory before it gets sold to your customers? Uh, if you have lower days, it means it is high efficiency. Here, here basically high turnover means high efficiency. Here in this case, lower days, lower number of days, because we are trying to convert it into days, lower number of days gives you higher efficiency. You're holding on to inventories less time. You understand? So lower days gives you higher efficiency. Are we clear? Are we clear? Okay. Now, how can your inventory ratios change? Why can there be a movement? Because of improved or very bad inventory control. Your inventory control system is very bad. That is number 1. Why can there be a change? Number 1, inventory management. You have to question the inventory management. How best are you controlling your inventories? Number 2, damaged inventories. So these can have an impact in terms of our inventories. Under liquidity, number 4, 1, 2, 3, 4, 5. Number 5, I can talk to you about in the exam. We can talk about trade receivable days and trade payable days, right? Now, trade receivable days is going to be trade receivables over revenue into 365 days. Now, what does it mean? On average, how long am I taking to recover my trade receivables? Am I quickly recovering my trade receivables, or am I taking time to recover my trade receivables? Now, basically, the longer I take, the longer my cash is with another person, meaning my liquidity is affected, my cash flows are affected, my working capital is affected. So basically, lower trade receivable days means higher cash conversion. So basically, keep that in mind. If it's lower days, I have good control over the credit period, right? I have very good control over the credit period. If it's higher days, my credit control is very, very, very poor. So better to have good days, smaller days. And also, it also means that I can have irrecoverable debts the higher the number of days. So a few things, credit control management. Number 2, number 1, number 2, number 2, irrecoverable debts. Are we clear? Are we clear? Everybody, are we clear? Okay, there is a question. There is a question. Is it on revenue or credit sales? It's on credit sales revenue. Okay, on how, because obviously credit sale is what is relevant for you in terms of checking how quickly are you receiving your money, right? So obviously, uh, in simple terms, it measures the number of days that you can collect the payments from your customer after a sale. No, so after a sale, if you receive the money, then there's no point. No, so it is with credit sale. Are we clear? It is with credit sale. Are we clear? Somebody had asked. I don't know. I'm getting a lot of messages, so I don't know where, but I just saw. Okay, fine. Okay, got it. Okay. So, but now number 5 that is done. Number 6, I'm talking about number 6. We're gonna come back to our trade payables period. So, trade payables obviously are credit purchases, trade payables. So, payables over credit purchases into 365 days. So, in the exam, in the exam, you can consider cost of sales as a substitute alternative to credit purchases. It is okay. In the exam, it's fine. Arutra, let me see what I can do. No problem. I've seen your messages. Let me see. Arutra, I'll try to pick whatever comes in. Okay. But it's not based on just one particular thing. I'm forecasting something for the exams. So it will be based on that. But if you're doing that question and if you have any problems, please let me know. I'll individually help you. Right. Because I see you sending me a lot of questions. I don't think I have enough time to do all those questions. If you have doubts, I can clarify. No problem there. Don't worry. So, coming back, trade payables, it's about average number of days that I take to pay my suppliers. Basically, I'm holding on to cash of my suppliers. I'm holding on to their cash with me. So, the longer it is, it's better for me because I've got cash flows. Basically, there are companies, what they do is they hold on to their payables, whatever they have to pay cash, and they do a small investment, a slight investment. So, yes, obviously, there can be issues with that also, that where you can lose negative goodwill, that you can create a negative goodwill. There can be so many reasons why your trade payable days can move up or come down. Probably you've got an extended credit agreement with your payables. It's a new supplier. Sometimes you're smart. You invest the money. Sometimes no, you're not smart. You take that money and you go on a family trip, meaning you're finding it difficult to pay off your trade payables on time. So that the higher the number of days sometimes might create a negative goodwill. Are we clear? Are we clear? Are we clear? Okay. One thing I want to work on this is your working capital cycle. Your working capital cycle. Now, what is the working capital cycle? What do we mean by a working capital cycle? Working capital cycle simply means the period in time for which your inventory is funded, from how you are funding your inventory, the time period of funding your inventory. That is from the date of payment to your supplier to the date payment is received from the customer. That is your working capital cycle. So your working capital cycle is generally calculated as your inventory days plus trade receivable days minus trade payable days. So once again, working capital cycle. Working capital cycle represents the period of time for which your inventory is funded, for which you purchased your inventory, you're funded from the date of payment to your supplier to the date of payment received from the customer, right? So, so I'm buying inventory now. I'm buying inventory now. I'm holding on to the inventory today, maybe for about 10 days, and I'm selling it to B. And B is paying me in about 20 days. So from the purchase inventory date to the customer payment date. In other words, I am purchasing purchasing inventory today, and I am paying supplier From this point onwards, I have to sell my inventory to receive my cash. Correct? My working capital cycle starts from my paying supplier my money to my customer paying me. This particular period is my working capital cycle. In this, few things will be involved. In this, number one, what will be involved will be my payable days. How long will I take to pay my suppliers? My payable days are involved. That is from this point to this point. My payable days, because that is my payment to my supplier, correct? My inventory days will be from this period to my selling inventory period. This is my inventory days. And my trade receivable days would be from this point to me receiving cash. My trade receivable days. Are we clear? Are we clear? Now, this is my entire working capital. Well, my working capital is, in simple terms, inventory days plus trade receivables minus trade payable days. Now, basically, here, the figure that I get represents many things. Number one, it represents, if my working capital cycle is smaller, it means I'm converting my inventory into cash quickly. My efficiency is high. Shorter working capital cycle equals high efficiency. Okay. So how can I bring this smaller? I can bring it smaller by reducing my inventory days and trade receivable days and increasing my trade payable days. So how can I make it shorter? Shorter can be made by less inventory days and trade receivable days. I bring it down, or increase my trade payable days. Arutra, don't worry, don't worry. I'll try it. I'll try it. I'll try it. Don't worry. I'll at least try to pick a few questions that you have proposed. Don't worry. Take it easy. Okay. Okay. Take it easy. Okay. Okay. Now I'm coming into financial stability of the company. So that's my working capital. That's my liquidity ratios, guys. So there you go. Under liquidity, I've covered current ratio. I've covered quick ratio. I've covered inventory turnover, inventory holding, trade receivables, trade payables, and obviously working capital cycle. I've covered the primary areas with you. And now I'm coming to my long-term financial stability, long-term gearing ratios. In terms of gearing, how can the company's financial stability be evaluated? So my last, I don't think it's not the last, but not the least, I've got investor ratios also to cover. Okay. We've got financial stability ratios. When talking about financial stability, one of the most important things that you need to keep in mind is your gearing ratio. So number one, your gearing ratio. Your gearing means your debt over debt plus equity into 100. Your debt includes all long-term borrowings, all the long-term borrowings, loan notes, redeemable preference shares, whatever, redeemable preference shares, loan notes, bank loan, everything comes into place. Equity, share capital, reserves, and if you have consolidation, you will have to take NCI also, non-controlling interest also. Or instead, you can also use debt over equity. This is also fine. So high gearing, if it's high gearing, in simple terms, greater risk. Higher gearing is later greater risk, meaning you are funding the company through borrowing. So number one, higher gearing equals greater risk. Number two, shareholders are concerned. Shareholders are concerned because the going concern can be affected also. Shareholders worry. If it's obviously low gearing, it's lower risk. Okay. Uh, Reasons why there can be movement, probably, okay, you went for a loan during the current year, you went for a loan, you issued shares, you issued preference shares, which is treated as a liability. You purchased assets for lease, can go up or come down. You've got reduction in retained earnings because of some losses that you're making, or you are making excessive dividends to retained earnings. Your retained earnings is affected. If your gearing is coming down, probably you're repaying loans. You're converting loans into maybe converting them into equity, debt from debt to equity, probably, or something like that. Your profits are increasing because of that. Your another reason can be your retained earnings going up, or probably you're revaluing your assets. So because of that, there can be reasons as to why your gearing can also change. Okay, next point, number two, interest cover ratio. Interest cover ratio. Interest cover is your profit before finance cost, PBT, profit profit before interest, PBI, profit before interest. Guys, I'm going very quick, okay? Over finance cost. So it shows, based with the profit that you have, how much of interest you can cover, how many times you can cover. So you have your interest that you have to pay. So from your profit level, how many times you can cover. So you just try to understand your default risk. This shows you the default risk to understand, okay, as a part of finance, interest cost, can we at least cover it? So that's the primary uh, logic behind it. And apart from that, guys, in terms of financial stability, you don't have to worry. That's the primary things that you need to keep in mind. Apart from that, you need to know EPS. EPS is IAS 33. It's a separate accounting standard. Probably profit attributable to the ordinary shareholders over the number of weighted average shares. You probably know. And your price earning ratio. Your price earning ratio is your current share price over your latest EPS. Apart from that, you will be tested probably with dividend yield, dividend per share over current share. And if you want dividend cover, it's profit after tax over dividends. These are the primary ratios that can be tested for you. Okay, let's get back. Let's get back entirely with a question. I want to do a question with you. Are we clear? But before that, I want you to quickly go through whatever just I've just wrote here. Quickly go through, and if you want, you can take screenshots also, no problem. But have a quick go through, quick, and give me a done. I feel some water and be back. Ziyan, can you please explain how to calculate capital employed? Okay. Uh, what is capital employed, Amani, first and foremost? Okay. Uh, your total capital that the company has, which you use to generate your profits. So it's an important metric evaluation of efficiency, your capital employed. Okay, how to calculate that? In fact, there are actually two ways to calculate that. Your capital employed can either be your total assets minus current liabilities, or your equity plus your non-current liabilities. Amani, are we okay? Are we clear? Your ROCE is obviously a profitability ratio. Right. Super. So let me go back. I am going to look at a question, um, a detailed question, obviously, which can be tested. Something like this can definitely come in the exam. So I'm going to see how to work around a question like this in the exam, and then we are going to take things forward from there. Okay, brilliant, super. The requirement here, the requirement is calculate the missing ratios in relation to H, calculate the missing ratios, and then write a report for the directors to assess the financial performance. Your performance means you're talking about your P&L, your position, you're talking about your balance sheet of H for the year ended 31st March 2015 compared to the previous year. Your answer should refer to the information above, and the impact that Sparks has had during the year. So you have to talk about the information given to you, and you have to talk about Spark. So there are a few things that you're going to talk about. You are obviously going to talk about the financial performance, the financial position of the company. You're going to talk about you're going to compare your financial statements to the last year, and your answer should have an impact of the information above and the impact that Sparks. I don't know who Sparks is, but you need to keep in mind there's some funny guy called Spark or a company called Spark or whoever has had during the year. So you need to keep all those in mind. Okay, super. Now to start off, uh, lock this. Okay. To start off, here you're getting 7 marks. Here you're getting 13 marks. So in total, 20 marks we know in the exam. Right, brilliant. Your ROCE calculated, you don't have to calculate. Your GP margin, you have to calculate. Your net profit margin before tax. Your examiner says before tax means please go do it before tax. You have to calculate. And then current ratio is calculated. Quick ratio, we know the formula, you have to calculate. Inventory holding period, you know the equation, you have to calculate. Receivable payment collection period, payable collection period, gearing, debt as a percentage of debt plus equity, debt plus equity, debt over debt plus equity. So yes, brilliant. We've got 1, 2, 3, 4, 5, 6, 7. 7 ratios in the exam. Calculation, I get my 7 marks. So basically in the exam, this is how it's going to look like. Right. Trying to connect my keyboard. So it doesn't disconnect. There you go. It's showing and it's connected. There you go. So let me also take Excel on my screen. Go. Right. That's done. And you've got 2015 and 2014. In the exam, how I want you to do the calculations, please listen to me. Guys, this is how I want you to do the calculations in the exam. Listen to me very carefully. Okay. 2014, you have 2015, you have 2 years with you. And then I want you to open up a new section, right? Your analysis of financial and financial performance and position. I want you to do it like this in the exam. Okay. We have few things to do here. Please try to understand, my dear. Please try to understand, my dear. You are going to talk about, write a report to the directors to assess the financial performance and position of H for the year ended 31st March 2015 compared to the previous year, meaning your last year's ratios are also important. Your answer should refer to the information above and the impact that Sparks had during the year. In the exam, in the real ACCA exam, this is how it's going to look like. This is the exact same way in your exam, it's going to look like. Okay. So you have your 2014, you have your 2015. First thing, you have your ROCE, you have your GP margin, and then you have your net profit margin. Then you have your current ratio, quick ratio, inventory holding, receivables correction period, payables payment period, and you also have your gearing. Remember, Ziyan has given you for each and every point how to talk in the exam. Ziyan has already given you. Now it's a matter of applying that in the exam. Okay. Now I'm going to make it very, very, very simple for you. Let's not complicate in the exam. Right? Here, try to understand. You are going to write a report for the directors, right? So you're going to write a report to the directors to assess. So to board of directors from, you are the IFRS consultant, for example, consultant, subject, um, uh, performance, and position analysis of Huston. From this point onwards, you can call it H, no problem. Date. So date could be, today is the 18th, is it? Yeah, 18th November 2024. So there you go. In the exam, you don't have the option of, adding lines. So you'll have to probably copy paste. But there you go. So you can say, dear sir, it's a report. So please make it look like a report. You don't overflow it, but make it look like a report, right? Yes, sir. Please find below ratios calculated calculated with the analysis done related to H in terms of performance and position. This report is solely for the use of the management of H only, and we do not take any responsibility for third party disclosure. There you go. Just keep it very simple. If it's a report, we'll try to give it like a report. Now, that is not going to give me 13 marks in the exam. That is just the structure, my structure. Now, only I'm going to come up with my analysis. Okay. Now, my analysis requires a ratio calculation. My analysis requires me to go back and read the scenario. Okay, I'm giving you a good 2 to 3 minutes for you to go through the scenario on your own and come in and then let's work around this question together. A good 2 to 3 minutes, maybe about 4 minutes, I can give you no problem for you to quickly go through so that we can cover it quickly together. Once you're done, give me a done, yeah? Once you're done, give me a done, yeah? Done. Okay, let's go further. Done with this also. Look at the additional information. Okay, right. In the exam, yes, you've read the scenario. You know where the information are to start working on your ratio calculation. So I would advise you to start off with your ratio calculation so that you know your understanding is better. Right, brilliant. Your gross profit margin. Obviously, you know your gross profit margin is your gross profit over revenue into 100. 2015 and 14 both are given at 31 and 37%. Your examiner has made our life easier. Oh, wait. I'm starting with ROC. Sorry, ROC. 31 and 37% already given. Meaning our ROCE has gone up. Our ROCE has gone up. Keep that in mind. Okay. And next, GP margin, let's fill in the blanks. 28, 14, 28, 14%. Okay, if you had already started working on 2015, please give me the figures. That's okay. If you've already started working on it, brilliant. I'll be very happy with you. 1.1 is to 1. And then I have 162 days here. I have 69 days here. I have 138 days here. I have 42%. Did I get everything right? 37, 28, 14, 14, 1.1. Okay, 0.4. I'm missing that. 0.4 is to 1, 138, and then there you go, 42%. Oh, okay. I'm getting it wrong. Basically, my 2014 figures are this, and my 2015 figures are here. Okay. 2015 figures are here. Okay, you have to be very careful. Look there, small mistake. Okay. Thank you. Headings are changed now. Okay, Abdullah. Okay. Take it easy, take it easy. Don't worry too much. You're there. Okay. Now, I've got my ROCE, and next I've got my gross profit margin. Everybody, gross profit margin. Yes, please help me. Please help me with my gross profit margin for 2015. What's my gross profit margin for 2015? Equals 3840 over 9600. It's approximately 40%, correct? Everybody, are we getting it right? Are we getting it right? 40%? Okay, brilliant. Everybody's getting 40%. Net profit margin, but your examiner has clearly mentioned your net profit margin has to be before tax. So please make sure you get your net profit margin before tax. How much is it? How much is it? Net profit margin before tax is how much? Please get the figure for me. 1218 over 1218 over 9600. Is it 13.3%? Is it 13.3%? I'm getting 13.3%. Yes, Kadina says 13. Shadia, please check. I'm getting 13.3%. Correct? Yeah, because your examiner says profit before tax, it's not profit after tax. So please get it right. Yeah, 13.3%. Okay, brilliant. Next, I've got my current ratio. Go to my current ratio here. Current ratio is my current assets over my current liabilities. How much is my current assets? My current assets are here at, I think, 3,400. My current assets are at 3,400 and my current liabilities are at 2,520, correct? Equals 3,400 over 2,520. 1.3:1. Current ratio is given in the question itself, sir. Yeah, it's given in the question. I'm sorry. Yeah, makes your life easy. 1.3:1. Your examiner has given you. Brilliant. Thank you. And your quick ratio. Okay, fine. Now that the current ratio is calculated, can you please calculate quick ratio for me? Because that is not given in the question. Quick ratio for me, please. Quick ratio for me, please. Someone has said 0.6. Can I go with 0.6? 0.4 to 0.6 looks like a slight improvement. Can I go with 0.6? 0.6:1. You know the calculation ratios. Please, please, please make sure that you work around it. Okay, everybody, you're getting 0.6, correct? Now let's move forward. Your inventory holding period. Yes, your inventory holding period. Please go back. Your inventory holding period. Please do the calculations for me. How many days? Inventory holding period. How many days? 114 days. I'm getting as inventory holding period. Everyone. Komal, how did you get it? Komal, how did you get your 114 days? How did you get your 114 days, Komal? Show us your calculations. Inventory over cost of sales into 365. Guys, everyone, please confirm inventory over cost of sales into 365. Inventory is here. Cost of sales is here into 365. Are you getting? Are you getting? Yes, that's right. Inventory is 1,800. Your cost of sales is 5,760 into 365, right? If your calculation is correct, that means 114 days has to be correct. Equals 1,800 over 5,760 into 365. 1,800. 114 days, correct? Yeah, I'm also getting that. 114 days. That's okay. Receivables collection, that is your trade receivables over your revenue into 365. Your trade receivables over revenue into 365. That's your trade receivables. You got to be quick in the exams, and that's your revenue. Please give me your answers, please. Please, can I have your answers? Trade receivables over revenue into 365. Can I please get your answers? Okay, I'm getting 29 days from few students, so I'm going with 29. I'm not going to make a change there. Trade payables payment period, so that's your trade payables over your purchasers is not here, so your cost of sales. Your payables is given to you. Your payables is standing at 1,680. Your cost of sales is 5,760. So how much is that? How much is that? Payable days is how much? Komal says 106 days, so I'm gonna go with 106 days. He's got few correct, so I'm gonna take some trust. Okay, Amani says 106. Okay, fine. And then we've got gearing, but our gearing, they say, examiner says that gearing is going to be debt as a percentage of debt plus equity. So debt as a percentage of debt plus equity. So there you go. Look at your debts. How much are your debts? How much are your debts? Your debt plus equity. Your debt over debt plus equity. Your debt over debt plus equity. Please take your long-term debt. My screen is blurred. Is my screen blurred, guys, by any chance? Is my screen blurred? Okay, give me a moment. Is my screen blurred? Numbers are not visible. Okay. Now do you see it? Now do you see it? By any chance, now are we good? Are we clear? Yeah. How many percent? Okay, now it's clear. My debt, my debt, my debt, long-term debt over debt plus equity. Please ignore, not required. Any answers? Any answers? Okay, why do we ignore deferred tax, sir? Because it does not give us a direct obligation to pay cash. So there is no direct obligation. Because of that, we ignore when calculating debt to equity ratios. Yeah, are we clear? So you can take all liabilities, can be loans, bonds, any obligations where you have a repayment obligation, okay? Because you are trying to understand the financial leverage of the company. So in other words, how much is the company funded through debt in comparison to equity? Are we clear? And when you take deferred tax is a temporary difference between your accounting written down value and tax written down value. It's more of an accounting entry for your future tax liabilities and assets. And technically, there's no cash involved. It's just an accounting entry. That's the reason. Are we clear? Are we clear with that? Okay, but most of you says 31.7%. So I'm going to take 32% as my gearing ratio. Super. There you go. I've got my 7 marks in the exam. I'm going to start off with my analysis. But remember, 37 to 31% is a bit alarming. 28 to 40%, yes, your GP margin has gone up. We need to say, we need to not just say it has gone up, why it has gone up. NP, net profit margin, has gone up. No, has come down, has come down. Your current ratio has gone up, looks positive. Quick ratio looks positive. Your inventory holding days are probably has come down. You're selling more inventories. Your trade receivables collection period has come down, and your payable payment period has also come down. Your gearing has also come down. Not just that, but we need to connect it to the scenario. Our analysis has to be connected to the scenario. Now I'm going back to the scenario. I'm going to try and analyze the scenario one by one. Okay, guys, so far, are we clear? Are we clear, everyone? Yes or no? I want everybody to respond. Are we clear so far? Okay, super. Now let's try to understand this in depth. Okay, let's try to understand this in depth. During the year ended 31st March 2014, H had been subject to much press interest concerning its poor performance. It has been subject to much press interest. So there's been a lot of pressure because of its poor performance. The performance has come down. The company's performance has come down. The performance has come down. As a result, its share price had fallen considerably. Share price falling down is a problem. Probably your investors, shareholders are a bit concerned. So one, poor performance. Two, share price has fallen down, not just little, but considerably. Keep that in mind. Okay. To remedy the situation, and help improve share price and market confidence. Share price about market confidence, guys. H employed Sparks. Sparks is a firm of strategic consultant. Okay, Spark is not a funny joker. They are a strategic consultant to recommend the best course of action to improve both its statement of profit or loss and statement of financial position. To recommend the best course of action to improve the P&L and the balance sheet. So coming back, when I'm coming here, look here, they say, write a report for the directors to assess the financial performance and position of H for the year ended 31st March compared to the previous year. Your answer should refer to the information above and the impact. Look at what your examiner, the word your examiner uses, right? Your examiner uses the word impact that Sparks has had during the year. So how has the strategic consultants had an impact in the current year's performance? Are we clear? Okay. The board of H were quick. They were very, very quick to act on many of Spark's recommendations and are pleased with the effect that it has had on performance during the current year to 31st March 2015. And they are pleased. The board of Huston were quick. They immediately acted on the recommendations, and they are very happy with the performance during the current year compared to last year. The draft financial statements are shown below. But you have revenue. Okay. When I see revenue, I can see revenue has dropped. Okay, revenue has dropped. So in the exam, if the revenue has dropped, I will immediately go and check what has happened to the overall profits. Revenue has dropped. I can clearly see from 10,000 to 9,600. However, the profits have gone up. So probably it looks like the consultant's approach would have been more than increasing revenue, but controlling cost. I mean, there are two ways to make a company profitable. By probably you can increase your revenue, you can have more profits, or decrease the cost, you'll have more profits. So it looks like in the exam, I'm going to talk about, look, it's not about revenue generation approach, it's more about cost control approach. Okay, right. There you go. Like I told you, secondly, I can see the cost coming down. I can see the direct cost coming down. Are we clear? Direct cost coming down. That is, of course, increasing my GP margin. My GP margin is going up. That can be connected with this as well. So your GP margin from 28%, it is obviously going up because of your controls on direct cost. Because your direct cost has come down drastically. We do not know why. Probably we'll have to go and check why. But it's more of a cost control strategy than a revenue increase strategy. Okay? Are we clear? Guys, everybody? Are we clear? Are we clear? Are we clear? Okay. My distribution cost is a bit alarming. It has gone up. I have to understand why. And my admin expenses have gone up as well. So I would expect my operating profits to slightly drop because these two have probably gone up by now. I know that. And I do see that as well. I have made a sale on my property for 200. And of course, my finance cost has come down. I need to see why. And I'm selling some plant. I don't know why. I'm keeping that in mind. So all those could have contributed to my profits. And of course, my taxation is coming down big time. My taxation is coming down. Okay. Overall, yes, the profit has gone up. More of a cost control approach, direct cost. But we'll have to see in detail what the notes say in the exam. We can't blindly jump into a conclusion. Okay. My property, plant and equipment has come down. Yes, that also speaks about the sale and the profit on sale of plant. That also speaks there, can be connected. Goodwill is still the same, and development cost, I've had double 120. So it looks like, I don't have development cost anymore. I don't know, probably my development was not successful. So probably I would have expensed it. That could be one of the reasons. That could be one of the reasons why my expenses here is going up. Could be. We'll have to go and check in detail. My share capital is still the same, but my retained earnings shooting up big time. Okay, I'm going for a loan. So probably I'm taking a loan this year, a convertible loan, and I'm also settling a loan. Okay, so I have to see from 2000 becoming 0. My deferred tax is coming down. Provision for overhaul. Okay, they are providing some overall expenses. Provision. IAS 37 is not permitted. So I believe there is a problem, mistake with the accounting treatment. IAS 37 does not provide, allow us to provide for overhaul. Overhaul is repair expenses of assets. It doesn't provide. Trade and other payables is coming down. My taxation is going up, and my bank overdraft from 1340, I have a positive bank overdraft. Okay, now if I have to go back, and check what the ratios say. Ratios are also exactly reflecting this because obviously we've done it based on the financials, but we have to go and check what the additional information is talking about. During the current year, the development expenditure was written off. There you go. We guessed it right. Development expenditure was written off to admin expenses. That's the reason why admin is going up. The statement of P&L as the recognition criteria of IAS 38 were not met. So in line with IAS 38, basically, it did not meet the criteria of IAS 38 intangible assets, capitalized development cost, technical feasibility, commercial viability, management intent, future cash flows. So all those conditions have to be satisfied. It did not satisfy. Because of that, what has happened? We wrote off the development cost to the to the in the current year we wrote off. So how much is it? Write off is about 1.1 million in development cost, which is obviously a major impact to our profits. Which is a major impact to our profits. Akash, I didn't understand what you want me to explain again, but there is a major impact in terms of 1120, which is included. So basically, if you see, technically our admin expenses has to be 1860 minus 1120, right? So 1860 minus 1120 should have been, but this has affected our financial statements. Overall provisions, overall, let me come back to that again in a bit. When I'm trying to work that. Okay, let me not lose my flow. Okay. In addition, following on from one of the recommendations of Parks, Huston is outsourcing the manufacturing of one of its products. Okay, there is an outsourcing happening. What you are doing is you are reducing your cost of sales probably because you are not manufacturing anymore. That could be one of the reasons why your cost of sales is coming down. Are we clear? So one of the reasons why your cost of sales is coming down is because you are outsourcing. So probably, okay, here I can say cost of sales coming down. Here, admin affected big time. Okay. There you go. This has enabled the companies to dispose some of the surplus plant. So because you are not using your plant, you are selling it. Okay. But it needed some repair, which was supposed to happen in 2015. Now that you have disposed, the repair is not happening. So therefore, what is happening? Your overall cost, your provision for overall cost, 1,480, which you provided for, is not there anymore. However, guys, try to understand this is not permitted. You can't provide for overall cost. Overall cost is not allowed. You can't take the overall cost into the financial statements and bring down the expenses. Not permitted. There is a problem there. Now did you understand? Now for me, I want to understand. Huston has been acquiring a provision for overall cost over a 4-year period, but due to disposal, this was no longer required and the provision was released to cost of sales. Meaning all these years you've been charging overall cost to your cost of sales, but this year you released it from your cost of sales. Because you released it, it looks like your cost of sales has come down drastically. That could be another reason for a drastic improvement in profits. Your treatment is obviously wrong, but yes. Are we clear? Are we clear? Okay. Can we start answering this? Okay, let's start answering. My keyboard. So, well, ROCE has come down. ROCE has come down, which is a major problem with the shareholders. So let's give a little background to ROCE. In the current year, ROCE has dropped. ROCE is a primary shareholder ratio. Basically, you know, ROCE is one of the most important ratios. Okay. Okay. So in the current year, ROCE has dropped. ROCE is a primary shareholder ratio. Therefore, this is a bit alarming to the shareholders. But ROCE, when you take ROCE, it's a matter of your operating profits over your capital employed, correct? Like I told you. So coming back to our earlier argument, your ROCE is a matter of your operating profits and your capital employed. Your operating profits is your profitability element, your capital employed. Your capital employed is your how much of revenue are you generating through your asset turnover, right? So your operating profit and efficiency, it looks like your efficiency is dropping down based on what we can see. Because your operating profit here, when I see, I think your operating profit is going up. I don't feel operating profit is dropping. Let me clarify it again. Your profits from, oh no, your profits from operations is coming down. Yeah, so that could be one of the reasons, right? So yeah, our gross profit is going up, so our operating profit is coming down. So there you go. Our ROCE can either be affected by our operating profits or our capital employed, but here it is being affected by a drop in the operating profit margin. So basically we can go forward and we can say it appears the operating profit margin has made an impact as this has reduced. And this has reduced. Okay. Now, you can, of course, talk why this has come down, because our admin expenses and distribution cost has gone up. In fact, the admin expenses and distribution expenses have increased due to it's gone up due to the development expenditure being written to the admin expenses. So due to development expenses charged to admin. Now, I'm not telling the examiner, look, it's gone up. I'm also giving a reason why it's going up. Are we clear? So in the exam, you need to make sure that you tell the examiner, hey, look, this is going up. Correct. But why is it going up? It's a bit of an analysis. It's a bit of a problem to the shareholders. Yes. But I have to tell why it is a problem. Are we clear? Now, next, GP margin is going up. We know our revenue has dropped, but we know there have been better control in terms of cost. So, GP margin has achieved a growth in the current year. This is due to due to uh, due to better cost control than than increase in revenue. Obviously, right? You know, when you say itself, your revenue has not increased, but your cost control is really, really, really good. So we're going to talk about that, right? So that is one point that we can talk about. The second point, what else can we talk about? Guys, go on. What else can we talk about here? Why do you think this has achieved? This happened? Why? Why? Why do you think this happened? Why? Outsourcing. Well done, Shadia. You've made an outsourcing decision. So your cost probably has come down because you've outsourced. Now look here. There you go. They say, following one of the recommendation of Spark, HCO is outsourcing the manufacturing of one of its products. So probably that could be one reason there where your direct cost is coming down. This is due to outsourcing outsourcing uh one of the products manufactured in-house earlier. Outsourcing one of the products previously manufactured in-house. Okay. Okay. No, I don't think development cost is added to cost of sales. They say development cost is taken to admin expenses. So that's I don't buy that. I don't buy that. I don't buy that. But is there anything else that is affecting? Guys, go look for it. Is there anything else that is affecting? Well done, Abdullah. Others. What else? What else? Well done. Overall provision releasing. Okay. Overall expenses, that is a wrong treatment anyway. Further, in the current year, the overall was released, and this has also contributed significantly to the increase in GP margin. The treatment is incorrect in line with IAS 37. That is wrong. Are we clear? Are we clear, guys? Okay. Now, let's try to understand. Let's try to understand it further. Last year, you had this 1480, no, guys. Last year, you had this 1480, meaning this 1480 was included here, 7200. Now, let's try to add this 1480 or 1400. 1480. Let's try to add this 1480 to this. So that is 2800 plus 1480 gives you how much? 4280. 40 to 80, says Akash. So basically, this is a major contributor. So if you actually look at it, your GP margin would have been lower than last year. Would have been lower than last year if you actually look at it now. Let's say in simple terms, last year this can't be there, correct? So last year's GP margin would have been how much then? 40 to 80 over 10,000 gives you how much? 42%. This year 40%. Do you understand? This year 40%. So in reality, if that was not there, if the error was not made, the GP margin would have been dropped this year. In fact, a closer look will reveal that the GP margin would have dropped in 2014 if the overall cost is reversed in the in 2015, if the overall cost is reversed in the 2014 financials. Guys, do you understand? Yes or no? Guys, do you understand that point? It's a very important point. You need to be able to understand in the exam. Are we clear with that? Yes or no? Everybody, are we clear with that? You understood what I'm trying to say there, guys? Everybody, are we clear there? Everybody, are we clear there? Okay. Super. Now let's come back to net profit margin, right? Now, when you're trying to take your net profit margin here, you're taking your PBT, profit before tax, and here, in fact, is dropping down. And obviously, we know major contributors for dropping down. Although yes, there is a plant being sold. Okay, your major contributors to this is the development cost, obviously, and your distribution cost has gone up big time. Why do you think your distribution cost would have gone up? Shadia, why do you think your distribution cost would have gone up in the current year? There is a slight drop in the net profit margin. This is primarily contributed through the increase in indirect expenses, cost due to development cost due to development cost due to development cost, and there is an increase in terms of what? There's an increase in terms of what? Distribution cost. Why do you think there's an increase? Because you are outsourcing. Your distribution cost can go up. You should be able to conclude like that. And development cost and distribution cost, which has rose significantly due to outsourcing. Don't you see? Okay. Are we clear? Everyone, are we clear? Guys, do you understand? Are we clear? Everyone, are we clear? Everybody, I want everybody to respond. Guys, our liquidity and obviously quick ratio has slightly increased. So I can maybe put together and I can speak about how our liquidity has impacted. So let me also go and check how my bank balance is like. Okay, my bank balance from an overdraft is about 840. Looks a bit positive. So let me try to get that connected, right? Not a major improvement, but it's very slight improvement between quick and current ratio. Current and quick ratios have slightly improved compared to the previous years. However, guys, when you look at quick ratio, it is below the acceptable one benchmark that we have. However, the quick ratio is still below the accepted benchmark. Okay. How do we have a positive cash balance? Why do you think we have a positive cash balance this year? Why? Of course, our trade receivables have come down. Our inventories come down. But there you go, Shadia. Well done. Well done, Shadia. Brilliant. We've sold our plant, so that can also have an impact on our cash. In the current year, cash flows looks positive compared to an overdraft last year. Okay. This perhaps was contributed heavily through the sale of the plant. Okay. For cash flows to be more sustainable, operations should generate cash flows. Sale of long-term assets could also be an indicator of going concern implications, issues. Are you clear? I'm just trying to bring both together and show it in one listing. That's okay. No problem. You can bring it together. Okay. Wherever you can connect, it's still fine. Not a problem. Our inventory holding period has come down big time. It has come down big time. I believe it's because of outsourcing. We are not holding inventory, and probably we are trying to bring in just-in-time system where you need it, we give it. Yeah. So the problem with that probably could be, okay, stock outs. I need to make sure that I'm not running out of stocks. So inventory holding period has dropped significantly. This could obviously save in terms of, space and rental cost. This could save up on space cost for sure. Uh, the reason for this increase could be due to outsourcing. However, if adopting just-in-time system or uh, just-in-time system or holding less inventory. H must ensure there's no stockouts. Are you clear? Are you clear? Super. Uh, Trade receivable days coming down. Trade receivable days overall coming down. Coming down. Looks positive. The reason we need to understand why. The reason could be probably we are doing probably we are doing a debt factoring. Could be due to debt factoring. So debt factoring, still sometimes you have factoring with recourse, without recourse. I'm sure you would have covered when studying, when doing your syllabus. Debt factoring probably can result in risk if you don't pass it to the other party, clearing agency. But we have to see what is the basis of this. This could be due to that debt factoring. However, better credit control system can be implemented to ensure to ensure uh, to ensure trade receivables are properly monitored and managed. Your payable periods is going up from is coming down once again from 138 to 106 days. Obviously, you are paying faster, so better goodwill, maybe more discounts, but your cash flows are coming down. Without proper cash flows, you can't make this decision of paying quicker. So you need to make sure that you talk about that. Trade payables, days coming down, obviously improves supplier goodwill and also more discounts. However, without sustainable, where do you want to connect? Sustainable bank balance, probably yes. However, without sustainable cash flows, care must be taken when managing cash flows. Finally, we have gearing. Gearing 42 to 32%. There's been a 10% decrease, lowering business risk, not just business risk, also your interest payments. Initially, you had 12% loan note, but now you have 10%, 8%. Looks like it's a good strategy. From 12 to 8%, your finance cost is coming down with equity conversion. Now you've moved to an equity conversion rather than a loan, a liability. So low interest rate, low risk. So, but however, with conversion, your EPS can be affected. It could dilute your earnings per share. So EPS should be calculated to inform your shareholders. So yes, gearing has come down and looks a good strategy from moving to 8%, 8% loan to moving to 8% convertibles from 12% loan. Therefore, reducing financial risk and financial cost. Okay. However, convertibles will impact EPS, earnings per share, and this to be calculated to notice shareholders or investors. Okay, with that, I can give a slight conclusion in the exam. A slight conclusion would do, no problem. It appears Sparks recommendation did show some improvements to the financials, as liquidity and GP has slightly changed. However, immediate action must be made to improve revenue and better control cost and liquidity. Okay. For the analysis to be more conclusive, we need further evidence, further information, such as number one, past financial statements. Number two, budgets and forecast. That's okay if it's forex in the exam, that's fine. If you say forex, I know there's a mistake, but that's okay. Your examiner wouldn't mind it, no problem. Number three, competitor analysis, what's happening the competitor within the competitors and external environment. I want to understand that. Number four, any political pestle analysis, pestle voters, pestle swap, external internal analysis, and any other relevant information. There you go. There you go. That's how I get my 20 marks in the exam. I know for this 20 marks, you can spend approximately 20 into 1.8, about 36. I'll say about 40 to 42 marks. But don't panic in the exam. Try to see wherever you can work around, connect, and try to answer the questions. Can we mention about the error? I did mention the error somewhere here, so let's not repeat it. Don't have too many repetitions. Just speak about points. That's enough. You will get your answers. You'll get your marks. Are we clear, everyone? Are we clear, everyone? Are we clear? So I'm trying to share this with you. Okay, FR marathon. Okay, so there you go. I'm trying to share it with you. So it should be here. Tomorrow, once again, I'm going to meet you at 6:30. But let me ask you, do you want to do another question on ratios, or can I start off with consolidation tomorrow? Or can I start off with consolidation tomorrow? Consolidation, one cash flow question I've taken, consolidation. Okay, let me see if I can do another ratio question. Let me try. If time permits, definitely yes. But tomorrow, let's start off with consolidation. I'm going to show you how to get your consolidation right. Thank you everyone for the session. I hope the session was good. You enjoyed it. Until next time, take care. Bye bye. And that is until tomorrow. Okay.